Good afternoon, uh, uh, everyone joining this call today. This is Joshua Adedeji, the program manager for ADE West Africa. I said good afternoon because it's 3 p.m. in Lagos, Nigeria. So some of you might be calling in. It's pretty early for some. I know it's about 10 a.m. for Meghan and for Olatunji, maybe 9 a.m. For some others, it's 7 a.m. So from wherever you're calling in from, good morning, good afternoon, and good evening to everyone. So we actually going to give like a minute more for every other person to actually join in. I really want to appreciate every other person who joined in early. We had people joining since about 15 minutes to the call. Really want to appreciate your commitment to these sessions. So let's give about 50 more seconds for people to join in. I'll be right back. Thank you. Okay, so while we're waiting for others to join, thank you again, this Joshua video for those who are just joining. We actually started this session. This is the third session we're having on a workshop series, which is actually supported by one of our members locally, ACT Foundation. And for every one of us, I believe we are familiar with Andy, but for those who are not familiar with Andy, Andy is actually a network of organizations that are supporting entrepreneurs in the emerging market. So we actually constitute like investors, the capacity development providers, the business development support providers, BFIs, like non-profits, and every others who belong to our members. And currently we have about 300 members working in various regions where we have a work. So we work in the West African region, which include the Anglophone and the Francophone region. And of course, on the call, we have some of our steering committee members who have actually been supporting our work locally. So if you have any question about our work in the region, please feel free to reach out to Andy staff on this call or probably after the call. So few instructions for this call. Please note that this session is being recorded. So if you would not want probably to be recorded, you might want to let us know. And then use chat box to ask questions. We're using the meeting tool. So if at a point the pastor would like to hear from you to unmute yourself, definitely you will be told to do so. But for every other question, please use the chat box. And of course, limit your activities in the chat box so that people could easily see the important questions and other things going on in the chat box. And then feel free to connect with every other participant who are on this call. We are not too many, so feel free to connect. And of course, mute your audio at every point in time so that others can actually hear clearly. So before I actually hand this over to the facilitator, I would like us to quickly do this to actually just kind of a temperature check to know what's going on with everyone. So on your phone or on your system, could you please log into menti.com and use this code? My colleague Confidence will actually pull this code in the chat box in case I switch to my other slide. If you got it, can you give a thumbs up? I want to know I'm not speaking to myself. Can you all hear me? Someone said he couldn't hear me, so can you hear me? Okay, thank you. All right, switch my slide. We have Gabriela. You're welcome. Can we do this very quickly? Well, I think you can review first, okay? If you're having difficulty using the tool, could you please let me know? Just on your system, go to menti.com and use the code to actually log in. We have a few more minutes to go. It's Tommy, you're welcome. Are we all active on this call? Okay, so while we're doing that, for those who are actually active on the call, sure we could actually move to the next question. Organization type. Okay. So a word to describe how you're currently feeling. Amid the error. So how you are currently feeling. We have just a minute and 30 seconds to do this, and my time will be up.
Looks like Menti is quite slow this today. Please be patient with Menti.
Thanks so much for that. I could see some comment in the chat box. People find it difficult to use it. It's actually slow on some people's system. So just be patient. Thank you. Productive learning mode, optimistic. Great. Yeah. Happy to see that no one is tired, sleepy. All right. Thank you so very much, everyone. If you're still typing, you could continue typing. But for us at Andy and for all our team members, we are really excited about this meeting, and of course about the session we're going to be having today with Meghan. So today we're actually going to be having like a session, which is actually will be more tailored to investors. But of course, we understand the fact that we have other people from who are capacity development providers, who are BDS, who are from the university, who might actually also want to learn from this. Just permit the technicality of what you might be listening to, but of course, we have quite a number of investors on the call who are actually going to be leading this session. And of course, it's quite an opportunity for everyone to also learn new things. So one thing we're focusing on today is actually innovative deal structuring in time of crisis, or even when it's not time of crisis, when things are okay. But we're looking at how investors and other financial support providers are actually getting innovative with this structuring when it comes to impact enterprises. And leading this session today is Meghan Curran, the director of Acumen, West Africa. So my time is up. I'll hand this over to Meghan and Yvonne, who are actually going to be leading us through this session. Hi, Meghan, you're welcome.
Yeah, thanks so much, Joshua, for the introduction, and thanks everyone for joining us today. Really hoping that this will be more of a dialogue and a conversation. Acumen is going through our own journey on trying to integrate more innovative financing structures into our suite of tools that we deploy in investing in different companies. So what I thought I would do is I'm just going to share my screen here. And I wanted to do a brief introduction to Acumen because I think it will help set the context for why we're thinking about innovating on some of the existing financing structures. And then we'll try to open up the conversation to hear more from each of you. I know I saw some impact investors as organization types, as participants, and some ecosystem enablers. I'd really love to hear from any entrepreneurs, if we have any entrepreneurs on the line, because I think they're often on that receiving end of these instruments, and they can also help inform the discussion of what's working and not working. Feel free to drop questions or comments in the chat, or even take yourselves off mute and interrupt me. We don't have to keep it so formal. Really do want to hear from everyone. Okay, so Acumen, for those of you who are not familiar, is a nonprofit impact investor, and that means that we take in grants from different foundations, government institutions, high net worth individuals, and we use those grants to make patient capital investments. So we make primarily equity, although we do some convertible notes and some debt in early stage social enterprises, accompany those enterprises as they, on their path to scale and maturity. And then where a typical investor would, exit their stake in the company and return the proceeds from that exit to their investors, we actually take that capital and put it back into our investment pool so that it gets used again. And we designed this model in the early 2000s to give ourselves and the companies that we were investing in flexibility on two fronts. One is that we have a more flexible time horizon. So for investors that are operating within a typical fund structure, there's a timeline in which they have to make their investments and then make their exits and return that capital to their investors. And we anticipated that for companies that were primarily serving low-income individuals, it might be a longer path to achieving profitability or achieving scale. And so we wanted to have that flexibility of time. And so this evergreen fund model gives us that flexibility of time. But the second piece, and perhaps more important piece, is that we're not forcing a return objective that forces the company to focus on higher income customers, for example, or on maximizing returns at the sake of everything else. We wanted to implement a model that would enable social entrepreneurs to be able to preserve the social objectives and the reasons they had founded the company without having to worry about shareholder demands that didn't necessarily align to those objectives. This is the model we've been largely operating with for the last 20 years, and yet we're starting to ask ourselves some questions about, you know, what of our objectives are being met through this model, and what are some things, some aspirations maybe that we're still not fulfilling, and may need to think more creatively about how we structure our investments. I'm going to skip the next slide because Joshua covered this a little bit in the intro. I was just trying to get a sense of who's in the room, but hopefully I'll get to hear from some of you directly. So yeah, I wanted to really start the conversation in this question of why does investment or impact investing need innovating in the first place? And so as I was saying, Acumen's overarching mission is to use investment to support companies that are tackling problems of poverty or inequality. But we're really following in a lot of ways, other than what happens with the proceeds from exits. Much of the rest of our model and the instruments that we use look like traditional venture capital models. And so this question of why are traditional venture capital models and instruments potentially insufficient, and where are the gaps? And then on the flip side, what are features of this model and instruments do we want to retain, or that we think are working for us? So I have a couple from our side, but I would love to hear if there are investors or entrepreneurs on the line that have any reflections from their own models or their own investing work in terms of what about these traditional equity and debt instruments are working or not working.
The circumstances, we increased it to 3, but put them close together. So the first tranche, just for an example, was in June, and then the second tranche will be about 3 months after September, and then the third tranche will be in December. And what we did was we focused on investing in the most important things first. So because the company was a manufacturing company, they needed to stock up inventory so they are able to continue with their production, which will bring in revenue. So we made sure they had enough inventory, and that is what our first tranche went to do. And then other requests for CapEx was pushed to the latter part because that was not as critical during the pandemic as getting them enough raw materials to continue production.
That's great. That's great. Thanks so much for sharing. And it's great that you were able to, I mean, nothing has forced innovation like COVID. So whether we were looking for these things or not, we find ourselves getting a little more creative and a little bit more willing to compromise. Did anyone else have any other comments, constraints they faced in lending, or other constraints that they wanted to mention? Okay. If anyone else has examples of creative instruments that have worked, I'll open the floor in a couple more minutes back open to that to see if there are others. But if I jump back in just to our universe where we were trying to evaluate like the things that we think are critical that we want our model to represent, and where we're achieving that and where we're missing it, or where it's intrinsic to a typical VC model and where it might be missed. These are the 6 criteria that are important to Acumen. Again, these will be different for every investor. I think I've touched on a number of them already. I guess one that I want to mention is this idea of social scale. We really look at companies that we're investing in, that their potential for achieving social scale can happen either through traditional growth, and again, it doesn't have to be this exponential hockey stick, but could be a more incremental growth over time, although that has to be taken into consideration in terms of how you structure the transaction. Or it could be a high-risk, innovative model that we know, for whatever reason, we find this often in agriculture actually, is not going to achieve some tremendous scale. But if we think this model could work in other places, then there is still a way for us to achieve that social scale. And so the value of doing the demonstration model, whether that company replicates it or others in the industry or sector replicate it, is still sort of meets our criteria for scale. And so just some of these where we're tweaking or adapting what the traditional definition of scale might look like and opening it up to align more closely with the objectives that we're trying to achieve. The poverty focus is there, the catalytic capital. I mean, catalytic capital is particularly important in our context, and I think all VCs strive to play this role. For us, because we use philanthropy to make our investments, we really try to take risks and take bets that more commercial investors are unwilling or unable to, and play that de-risking role. But it's very easy to get swept up and go where everyone else is going, and suddenly you find yourselves investing in the same deals or the same sectors, and how do we continually push ourselves to be in that catalytic place. And then the last one I'll just touch on briefly as well, which is like geographic diversification. And in some ways, this is also kind of, would say it's geographic and sector diversification, really. That in venture capital, there are these herding effects and these, whether through the same networks or the organization of a particular sector, where everyone is suddenly focused on solar home systems or renewable energy, for example. Or it's very easy for all of the investors to congregate in Lagos, but how do we continue to maintain a reach and a breadth that goes beyond that? And that requires a little more proactivity as an investor to it's not that you're going to meet the same companies at the business plan competitions or the conferences or events, but really having a more boots on the ground or ground game in terms of getting out to second and third tier cities, exploring sectors that are not as well organized and don't have all their annual events bringing together investors and entrepreneurs to be able to look for those opportunities. But finally, if we come to some of the alternate structures to consider, and apologies that these slides are a little bit text heavy, Acumen doesn't use all of these. They're a range of examples that we've pulled from other funders and that we've tried to evaluate and consider and see if they fit with our model. But I thought I would share, the range of them that we've looked at. This is in no means an exhaustive set of slides. I think, as Yvonne was alluding to, a lot of it comes from tinkering with the existing tools until you find a form that fits whatever the objective is that you're trying to achieve. But the two that we have here are community investment or democratized ownership structures. And these can sometimes be structured through investments where you're doing ESOPs or some of these other employee stock programs. But I think the more extreme version of it is investing in worker-owned cooperatives. We've seen different challenges with ESOP models in the companies in our markets, where a lot of employees don't put the same value on like a long-term, ambiguous, hard to calculate value of a stock option, and would rather have an annual bonus or some kind of profit share, short-term liquidity. But worker-owned cooperatives is where, it's an entity that's owned by the workers or by the farmers that may be part of an association. And how do you invest in that entity so that, again, the wealth generation stays at the community level? And I'll talk about an example from Acumen's portfolio in just a minute on that one. The second is crowdfunding, and using crowdfunding as a way to access local investment and also keep it local. So where can you crowdfund, very small amounts of capital to be able to lend to small businesses that may not have collateral or meet the other requirements of commercial financial institutions, I think we've interestingly seen a number of these models in Nigeria as it relates to agriculture, and see them occasionally popping up in different sectors as well. I think this is, you know, there are two sides of this, because it's kind of like where you're sourcing the capital from, but then also what flexibility it enables you in terms of structuring, and how you structure those transactions. On the next slide, I go a little bit more to self-liquidating, like quasi-equity or equity instruments, and then some of the options across debt and recoverable grants. So in self-liquidating structures, there's a range of these. I think the overall principle is that it looks like equity going in and feels like debt coming out. So the example that Yvonne mentioned is a good one. We have a couple in our portfolio where we've done equity redemptions. You know, we make an investment, we say that at this 7-year period, the founders will have an opportunity to buy back the shares from Acumen over a period of time, so that their resulting ownership is not diluted. There's a benefit for the founders and the company, obviously, in that, where they get to retain ownership and control of the company longer term. There's also a huge benefit for us. In this instance, it was an agriculture company in Sierra Leone, and we couldn't see a path to where there was going to be some big secondary investment. There definitely wasn't going to be an IPO. And so it was a little bit self-serving in thinking about how are we going to get our capital out of this company, you know, when it's run its course, and where some of these self-liquidating instruments can be really useful. I think, you know, the distinction between using revenue-based financing or demand dividends or redemptions really depend on the nuances of the business model, what their cash flow models look like, and what makes the most sense in a specific context. If we come to these, some of these are more traditional working capital or CapEx debt. And again, like Acumen did a lot more debt in its early days, and then wanted to have more control and play more of an equity investor role. But as we look at a number of the companies that we invest in still struggling to raise local debt, have considered adding that back into our mix. Doing something like debt guarantees, we're really not set up for that. It requires like a much deeper balance sheet, but is something that we've seen other impact investors play a pretty big role in providing. And then recoverable grants, which are in some ways a zero interest loan. So I think it depends on what your preferred terminology is, or forgivable loans with no return component. I guess what's not on here and should be is that there's also a breed of performance-based financing, and I think particularly lending, where if you tie it to the achievement of different social objectives or performance objectives that are, you know, business objectives that align with the social objectives, where you could then reduce the interest rate, or you know, it could be tapped down over time as a way to reward the company for meeting those social goals. So again, this is by no means an exhaustive list, just some of the things that we've looked at and played around with, and that I think are picking up traction across the market as well. Tunji, I see you came on video. Did you have a question?
No, I just didn't want it to be alone on video.
I appreciate that. Does anyone else have a question or a comment? Anything to add? Maybe a favorite alternate structure that I've missed here?
Although I have a rookie question, a question of someone that is a finance expert. I see crowdfunding companies coming up, doing like seeking investment from individuals and then invest in small businesses. Some of them promise as much as 30% per annum return to the investors, and that gets me a little bit worried. Do you see are returns that high from small businesses in the region, or are they just being bogus, just trying to get as many funds as possible into their portfolios?
Yeah, it's tricky. I'm a little more skeptical of some of the crowdfunding models because from a social impact perspective, if you're trying to provide that high of a return to your mini investors or your crowd of investors, and you're covering the operating expenses, and a lot of the models I've seen in Nigeria have been connected to agriculture, and so if you're also trying to provide an income increase for smallholder farmers, I think that math is pretty tight. I haven't personally looked at any of those models super closely or seen if they're actually delivering on those returns. So I don't want to be unfair in terms of like unfairly negative, but I think it's a good question in terms of what the feasibility of that is and what some of the downstream or like byproduct effects of that might be. 30% is not that far off what that company would take from a bank. And you know, and so in some ways it's not as crazy as it may sound in terms of sticker shock. But I think it really depends on the specifics of that business model, even down to the value chain, I would argue, within agriculture, because what you can do with cassava versus what you can do with pineapple is a completely different sort of equation.
I agree with you, Adam. Those are my concerns also, Adam, because some of them position themselves as impact investors trying to help small businesses. But when I see the return that I actually invested a small amount of money in one of them just to test it and see if it's really true that they can give that much return, or they're just trying to incentivize people to pull in the fund and then maybe change the terms along the way. But thanks for the insight.
Yeah. And I'll be as happy as anyone if they succeed and it works out. So remains to be seen. Any other questions or comments on these?
We actually have a question in the chat box.
Oh, sorry. Let me find the chat box. Oh, it's not coming up on my side. Could you read it to me, Joshua?
Okay, the question is from Heflin. Could you give an example of equity redemption that you used?
Yeah, so the equity redemption that we've done, we actually just started, so we haven't seen it be fully redeemed yet. But it's the one I was mentioning. It's a company that's an agriculture company that has operations in Sierra Leone and Ghana. And they primarily work in rice and maize. So again, we knew that there's nobody looks at them and sees dollar signs. For us, it was like a means to an end to be able to give them capital to work with the smallholder farmers that they're working with. And they had a pretty interesting model, but we structured that investment so that I think at the 7-year mark, based on what their cash flows look like, based on what profitability looks like, the company will have the option, or the founders will have the option, to buy back Acumen's shares at a price that's determined. You know, there's a cap to it, but a price that's determined by some combination of those metrics. And they buy it back, I think, in 20% chunks over a 5-year period. So we'll still be in that company for 12 years, but we know that, you know, at the end of 12 years, we can at least see a path to exit, and they have different options as to whether or not they want to exercise that redemption. It does cap our upside. Like, we have to put a limit on how we would price that for them to be able to buy it back. But again, because that's not a primary objective for us in terms of maximizing, we know that we could still make some upside without it having to be this, you know, the imaginary upside of an IPO, if you will. It's kind of like, what's the expression? A bird in the hand is worth 2 in the bush. So for us, the trade-off of capping potential upside down the road made sense as against, you know, leaving it in a more traditional structure and then crossing our fingers that there would be some secondary sale or some other event where we would, yeah, win big. Does that help?
Yes, it does. Thank you, Megan.
Great. So I have one other case study I wanted to share, and again, sorry for the text-heavy slide.
Sorry, Megan, before you go,
yeah,
there's another question
sure.
from Yvonne. She said, can you share an experience of the demand dividends? Have you had challenges with any of these instruments with entrepreneurs?
Yeah, so we haven't done any demand dividends yet. So I unfortunately don't have a good or bad experience to speak from on that one. But if anyone else on the phone does, welcome you to jump in.
Yeah, Megan, I also wanted to find out with the equity redemption if you've had any challenges, but obviously you haven't gotten to the point where you've been redeeming yet. So
yeah, we don't know. Yeah, we don't know what we don't know. Which is kind of why these traditional instruments looked good 10 years ago or 15 years ago, and we're, you know, finding out now that they're challenging. So yeah, I'll keep you posted, Yvonne.
Yeah, right, thank you.
Anyone else on the line that has experience with any of these that can speak to some of the pros and cons or have questions about them?
Maybe I can take like 2 minutes to tell you about our experience. I am the managing director of Week Capital, a gender lens fund based in Senegal and targeting women-led businesses in Dakar, in Senegal and Cote d'Ivoire. So recently we invested in, we just closed the deal actually, in a local designer brand. And we wanted to do the demand dividend, but the specificity for the OWADA space and talking to our lawyer was that we couldn't have such a loan instrument. So we tried to implement it with shares, with equity, like having, bringing our investment and being reimbursed with a percentage of cash flow. And finally, what we did, it's not always easy to implement with our local jurisdiction. So finally, what we did, we split our investment with one part as shareholder debt, the other part as ordinary shares, and like 25% of our investment as preferred shares, so that we will get a percentage of the net income instead of cash flow, for example, but distributable net income. So concretely, we will have, from the shareholder debt, we will have regular interest, and the interest rate was 12%. From the shares, ordinary and preferred, we are getting future dividends when we get them. And from the preferred shares, we are getting 25% of disbursable net income. So we just wanted to try the demand dividend thing, and then talking to the lawyer, sometimes you realize that it's not feasible that way, and you find an hybrid instrument. And I think the instrument that we have has no name. It's a mix of equity redemption and demand hybrid and whatever. Yeah. But at the end of the day, the goal is that we are exiting in 6 to 7 years with an IRR that we are targeting now. And the entrepreneur is going to buy us back at nominal value.
That's
and
great.
And the shareholder debt would have been reimbursed anyway in the meantime.
Yeah.
Okay. Okay. Well, thanks.
But that's the same. The reason why we did that is the same issues you underlined. Like exit is so uncertain, and when you are in this kind of industry, creative industries, fashion, everybody wants to invest, but I'm not sure we are going to find any exits for this kind of companies. Yeah.
Okay. Yeah, if we have time, I just wanted to find out, Evelyn, what do you do if at the end of the tenure, the entrepreneur decides not to buy you back? I mean, are there clauses that mandate tying him down to buy? I know there will definitely be that, but what is your recourse when he decides not to, or he pretends he doesn't have the funds to buy you back?
The value is nominal value, so it's like it's really cheap. So it's in her interest to buy us back. If she does not, we can exit to others, to other funds, to back to third parties. But it's in her best interest to buy us back.
Right. Okay.
Because the shares are just really cheap.
Yeah.
Okay.
That's smart.
Okay. Thanks.
Cool. Yeah, we should have had a lawyer join us for this, because that is definitely where the rubber meets the road on some of these.
The OWADA space is really not simple. And besides OWADA, you have the central bank that is also managing the interest rates. For example, I'm not sure we can ever have an interest with 25% interest rate, like the deal even made in.
Oh, wow.
Yeah.
Yeah, ours is in local currency, so, and our banks usually, some of our banks lend higher than that, so it's always quite competitive.
Yeah.
Yeah.
Exactly. Okay, great. Did anyone else want to chime in on this before I just move to the other case study? Okay, so this is one that Acumen did about 5 years ago now in Colombia, and it was our first investment in a farmer-owned cooperative. So we talked a little bit about self-liquidating, I talked a little bit about cooperatives, but when you first go to make an equity investment in a cooperative, the exact definition of a cooperative is that it's owned by the members, not by shareholders. And so the legal constraints there came up quickly. In this instance, it was a cooperative of coffee farmers in Colombia who were growing coffee and selling the beans, let's say, or the cherries raw to a middleman who was doing some level of processing and then selling it onto Nespresso. And the association wanted to be able to have that wet milling capacity themselves so that they could capture more of the value than they could from the raw cherries. But because of their operating model, they would never generate enough free cash to be able to purchase that equipment themselves. And so that's what they were seeking, this equity or equity-like capital to be able to do, is to invest in that equipment. What Acumen did was to help them establish a holding company, so an entity separate from the cooperative. We put the investment in, made an investment in the holding company, so took shares of the holding company, and then structured it such that the cooperative would buy back shares of the holding company from Acumen over time, so that ultimately the cooperative is an entity in and of itself, and then also owned this holding company, which really just existed so that they could take in different types of financing to manage their operations, other than what is legally allowed within the structure of a cooperative. There were a lot of huge benefits to this. It really opened the doors for us and was the first example of investing in an entity that is community-led and community-driven, more than having a single entrepreneur who is trying to tackle a problem. Really was this association of farmers, and where the depth of impact, I think also, you know, it's 300 or 500 farmers, but the income increase for them was between 30 and 50%. So pretty deep impact by our standards. And then again, this idea of agency and ownership, which are some of these like soft ideological benefits, but something that we're actually starting to try to figure out how to measure. This is in the post-conflict regions of Colombia, where after it's hard to say after, technically post-conflict, where their 50-year civil war has ended, and it's been a lot of humanitarian relief efforts, a lot of top-down development efforts, and where these communities really had an appetite for having a little more control over their business, their operations, and yeah, that just this idea of something that they owned. And so really have seen this as a powerful example, and was the beginning. We've now done a couple of deals like this in Latin America, and are trying to understand what it would take to be able to do them in West Africa as well. yeah, I think it has a lot of the benefits that we already talked about in terms of like taking care of this idea of not having prospects for exit, creating real equity ownership for the members of the cooperative. I will say it definitely was not as straightforward as a typical deal that we might do. It required a lot of hand-holding and support with the leadership of the cooperative, hiring a general manager of the mill, setting up their board and governance structures for the holding company, and doing a lot of the technical. We worked with TechnoServe, who helped them with a lot of the technical operations, but we were doing a fair amount of capacity building in terms of managing the business and managing not only the cash flows, but the forward-looking projections in terms of what additional capital they might need and so forth. Yeah, was an exciting example not only of shifting the instrument that we use, but also being able to shift, or how shifting the instrument kind of opened up a new category of company where we could have a really deep impact. And as I was mentioning on this idea of social scale, even though this one is only 300 or 500 farmers, that we've now done 3 or 4 transactions that look like this kind of ticks the box for us in terms of achieving scale. And because we structured it the way that we did, we're not relying on exponential scale of this individual firm to recover the capital that we put in. Any questions or comments on this model? Okay.
I have a question.
Yeah, please.
When you work with cooperatives, are they readily open to structure themselves that way, like setting up a third business, a third-party business, and being structured and formalized as a modern commercial company? Or is there? How do you make sure that the 300 farmers are acting in the same way and deciding in the same way?
Yeah, no, that's a great question, because I think this definitely is not a one size fits all. And even some of the cooperatives that we've looked at in Nigeria, where it's actually a handful of people that are running the show and renting plots to others, or it's not a cooperative in the true sense. I think the criteria that we've found to be really important in identifying, like evaluating a number of these different opportunities, is that one of the most important things was that some subgroup within the cooperative, if not the cooperative body entirely, shares the vision for where they're trying to go to. So we've had others where like an aid organization or a partner of the cooperative might say, hey, you should go invest in these guys. They need this kind of equipment. They should do da 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 da. But if there's not enough of that will or interest coming from the cooperative members themselves, then it's less likely to work. We're kind of happy to run alongside, but don't want to be in a position of pulling people to something that we think would be great for them, and getting back into those kind of top-down dynamics. But also the diligence in this aspect was much more about spending a ton of time with these groups, with subgroups of the cooperative, with the leadership, and some of the other partner entities, more than it was, a heavy review of historical financials. So the diligence process just looked different to be able to establish that trust. And I don't think it's a value proposition that every cooperative body is interested in or excited about. I think especially in the beginning, our team was actually met with a lot of skepticism, but had been, continued to show up and work with some of the other partner organizations that this group really trusted, and were able to pull it off. So I don't have like a concise silver bullet answer to that, but it's been a little bit of trial and error, and is very focused on some of the intangibles that help us diagnose like whether or not it's the right fit for one of these type of investments, I guess is the most I can say.
Thanks.
Okay.
I have a question.
Yeah.
You said one of the terms in for this deal is the debt financing is provided. The funder provides the third party provide a property for what you call, trying to see really exact thing.
So the collateral is provided by the real
collateral,
estate.
yeah, exactly. For and so where does the collateral come from? Since it's a third entity that is just been set up for this purpose, does the collateral come from the cooperative or from the directors?
It was that the land that they were taking to put the mill on, that
okay.
if they didn't pay back the loan, that Acumen would have taken ownership of that land. So
okay.
it was the same land that we were taking. It's whether Acumen would have ended up with it or they would have ended up with it.
Okay.
Yeah.
Question, because I mean this would like.
Megan, I have a question. How would you have approached it if the third party didn't have any collateral? Is it a must for them, or there's an alternative?
No, and in this instance, I think the value of the collateral was actually quite low. It was to have the cooperative have some skin in the game. So again, it was more symbolic and signaling than it was that we were setting some artificial threshold that we wanted them to meet so that we would capture back all of the value if they didn't repay the debt. It was really for them to also have something on the line.
Okay, right.
Sorry, there was another question coming through as well.
From me, Gabriella.
Yeah, hi, Gabriella.
Yeah, hi. For me, this sounded now like a typical case for leasing instead of having a loan-based structure that needs first a holding structure. Why did you decide to go through this complicated model? Does leasing not exist in Colombia, or did this never come up?
Yeah, that's a good question. I don't actually know whether or not leasing was an option, but if I had to venture a guess, I think it was like, even if they could have, well, one, I don't know even what their cash flows look like to be able to even lease. And then I also think that the leasing would have solved the problem of the physical equipment. There were a number of other things connected to knowing how to run the equipment, being able to manage the supply from the different growers, managing the relationship with the off-taker, where we really were working with them to like own and take on new business activities that they hadn't been involved in before. And I think that's where we felt like, I don't know from their perspective, from our perspective, having some of this equity-like capital where we had some ownership and could provide that like guidance and support and partnership was like, it was obvious that that was also going to be a critical part of what they needed. But it's a good question. I'll have to go back and look and see if leasing ever came up as an option. But I think of it more as like this idea of enabling them to manage a business unit essentially that they weren't otherwise.
Thank you.
Okay.
I think it's a great model.
Yeah.
Yeah.
Yeah, so this is actually my last slide, and where I was just going to open it up again to see, and Yvonne kind of spoke to this already in terms of the innovating that they've done in terms of COVID and shifting to kind of meet the demands of the moment. Acumen also had a case, I don't think we did anything wildly creative, but where we were about to invest in a solar company in Nigeria, and rather than do we just anticipated it would be tough to get through our investment committee in, I think it was mid-April or late April, when things were, it felt at the height of uncertainty. And so we extended a bridge loan to the company to get them through like a 6-month period, and said we would reevaluate the investment decision on the back of that. And we're typically not in the business of making bridge loans to companies that we're not also holding an equity position in. So it required a little bit of persuasion on our end, but was ultimately a great way to, take a very small bet and see, learn more about what COVID was going to mean in the Nigerian context, what it was going to mean for this company in particular, and then be able to make the investment decision when we had a little bit of a better grasp on what the world was looking like. And so just approved the investment actually last week, the full amount. But it was, yeah, I mean, I think similar, Yvonne, to your example, the situation forced us to take on things we might not have otherwise done. And then it opens the question to say, oh, are there other contexts in which, we could be convinced to take a really small bite out of something that's much smaller than our typical transaction size, as an entryway to then make the investment at a later date. And I don't think that'll always make sense in terms of transaction costs and time that you spend getting to know a company. But it's definitely, these moments that force your hand, I think, then help reflect on what else might shift going forward. Yvonne, I know you have also had to adapt your due diligence processes. I don't know if you wanted to share a little bit about what that's been like with the group, and then if any other investors or entrepreneurs on the line have had experiences over the last 6 months that they want to share, would invite that as well. But Yvonne, I'll hand it over to you first.
Okay, thank you, Megan. So as I mentioned earlier, just when the COVID hit Ghana and our president announced the movement restrictions, we were really in the middle of a due diligence to close our deal. And so we had to quickly continue this virtually. We had a couple of challenges because we had only about 4 weeks to present to the IC, and we had already done our model for the company. So that required that we had to put some aspects of the due diligence on hold and approach the IC to get approval to do that later and put that as maybe a condition subsequent to the transaction. And other things also had to do with getting a formal confirmation from a regulator of the company that indeed they had a valid license. So that as well, we couldn't get the letter on time. We had to set that as a condition precedent to disbursement. But what we did was we moved everything else to virtual. For some of the stakeholders that we engaged, their locations made it difficult to do video calls because internet connectivity was not stable. Some of them were smallholder farmers, and they also couldn't even respond to an online questionnaire for a primary market study. So all that were challenges that we faced. And we also now had to redo the financial model using a COVID scenario. So that's what informed the structure of the deal. But I'll say that that using that particular transaction has opened us up to being creative as to how we go about due diligence, because we're still now trying to close another deal that we've done all the due diligence virtually. But I think for us, what helped was the company was not entirely new to us. And so we had earlier on done a site visit before presenting the opportunity the first time to the IC for due diligence approval. So we were quite familiar with some of the company in itself, and then some of its stakeholders, suppliers and customers. And so the virtual meetings that we had, really, the information we obtained were not really different from what we had earlier seen. And so they did not emerge as deal breakers. I'll say that what affected was a bit challenging was the primary research that we didn't have information on. But then again, the company itself had done a lot of extensive primary research, and from my initial preliminary discussions with some of the farmers before due diligence, we had a couple of insights. So all that really helped us to be able to close the deal on time.
That's great. Congratulations, because I know it's been, it makes a hard thing harder, but
yeah.
I'm sure that company is grateful, and yeah, it sounds like it worked out well for you guys.
Yeah.
Did any other investors or entrepreneurs on the line want to share experiences they've had that any learnings or insights from transactions or innovations on structuring that have come about during this time? And if not, I guess, are there any more general questions or comments? I think we're a little ahead of time. Okay. Well, I hope this has been useful for folks. Again,
someone has a question.
Yeah.
It's from Chu Buikem. How does Acumen assess the enabling environment, such as government policy measures, before making an investment in a particular sector or company, especially in cases where these are generally uncertain?
Yeah. I was going to say we do and we don't, which is to say that we accept like a baseline level of uncertainty, and then do our best to diligence, as we're evaluating a particular business model or a particular sector, to understand whether it's regulation, whether it's tariffs, what are the other sort of government touch points that might influence outcomes for the business. But I think, more than that, the kind of cliche that you're betting on the entrepreneur or you're betting on the team is I think what comes to mind, because we've had a number of companies that have faced unexpected regulatory challenges, just as they face any other unexpected challenge. And the ability to pivot and look for an opening elsewhere is, I think, what ends up distinguishing. Of course, not in all cases. It's not to say that, like, by sheer will, you can make the company succeed. But I do think there's a component of assessing the regulatory risk, but there's also a component of assessing the team on a number of dimensions, and not only focusing on the business as it's presented today. If I think about our West Africa portfolio, I would say we have 8 companies. 4 of them we invested in like prior to 2016, and 4 we've done like from 2017 till now. And of the 4 legacy companies, 3 out of the 4 have had significant changes to their business models. Like, what they're doing today is not necessarily the company that we invested in, or the customer that they're serving today is not the customer that we thought. So it just kind of reinforces this idea that try not to get, like, you're attached to the plans and to the business model, but you also are expecting that 17 things are going to change along the way. And so ensuring that alignment with the entrepreneur and the management team and confidence in their capacity to adapt to ever-changing circumstances is a big part of the decision. Obviously not an easy one to predict. I welcome if others, Yvonne or Evelyn or others have anything to add on that point in terms of evaluating regulatory risk.
Yeah, I think that for us, like you said, it's really difficult, but we try to understand the regulatory environment. But most importantly, we look to confirm if there are any, the company in itself is compliant with regulations that are currently in existence, and most especially confirming their licenses, because in Ghana, most of the licenses expire within 1 year. So every year you need to go back and check. And what sometimes you find out is some of the companies will tell you that, oh yes, we do have a license. But when you do a second check, you realize that probably their license may have expired. So we try to, as much as possible, make sure that they are in good standing with the regulator. I just want to share one that we did. It was on a healthcare company. So they had labs and they wanted to set up a rapid test kit manufacturing plant in Ghana. The promoter told us that they had a license. Meanwhile, when we checked from the regulator, they only had a license to import just one type of products, but they were importing several others illegally. So if we hadn't gone back to check, we would have gone ahead and accepted that statement. But then he needed to get approval for every single item that he imports into the country. So I think that regulatory checks are really important, because apart from the reputational damage, it could also, that it will bring to the fund, it could also affect the promoter's ability to pay your money back if anything goes wrong.
Yeah, absolutely. I can finally see the chat box now. I don't know what happened before, so if anyone else has questions they want to drop there, or just unmute.
Maybe while people are putting their thought together, one question I wanted to ask is how do you factor COVID into your projections and due diligence and analysis of companies at this time to make your investment decision?
Yeah, thanks, Tunji. As I kind of alluded to, I think for us, it was a lot harder in March and April, where it felt like it was just starting out and it was hard to predict how intensive the lockdowns were going to be, for how long they were going to last, what the different impacts on the businesses were going to be. And Acumen really spent the majority of its time between April and July deploying small amounts of emergency funding to some of our existing companies to ensure that they were able to bridge through this period. And we did that in like 0 interest loans, or, as kind of concessionary financing as we could. I think 6 months in or 7 months in, we have a better sense, even if we don't know exactly like when the vaccine is coming or when we're all going to get it, we have a better sense of what the infection rates look like now, what lockdown implications would be if we went into another lockdown or a more intensive lockdown. And so even though there's a degree of uncertainty, there's also a higher degree of familiarity with that uncertainty, if that makes sense. And so I think there's a better, there's just a little bit of a better way to triangulate assumptions and make assumptions about, base case scenarios, best case scenarios, and worst case scenarios, factoring some of that in. But again, welcome Evelyn or Yvonne or anyone else if you had a different approach or have a better way to predict the future of COVID.
Yeah, from us, not too different, Megan, from what you've shared, having the multiple scenarios. But I think what we've also done is to reduce our own expectations of the growth of the company, and also to be a bit relaxed on the KPIs. So we increase our margin of safety and allow them to, for example, if they miss the targets, we rather will remodel the business plan and see whether our investments are still safe. And once it is, then of course, it's okay to still give them time to recover. I don't think anyone can predict with certainty, so we just have to keep an open mind.
Yeah. No, that's a great point. And that resonates for us as well, where, one of our companies was out raising money and they said, well, we have to keep this revenue target, and it's like back to the growth conversation we were having at the beginning of the call, like in a global pandemic, let's be realistic and, protect the profitability and and protect cash more than anything, because you don't know what the fundraising landscape is going to be. And relax a little on not, the board is not going to rake you over the coals if you don't 2020 growth target, being cognizant of what's in mind for the business in the long term. So yeah, that resonates hugely. Great. Thanks for sharing. Great. Well, that's officially all that I had. It's been a great discussion. I really appreciated, the input from some of the other investors. Hope this has been somewhat informative. And love Andy for exactly curating these kind of spaces where we can just learn from one another and share best practices as we continue to try to figure out what investing during COVID means, and also, achieving our dual social and financial objectives. So thanks everyone for dialing in. I'll turn it over to Joshua or Tunji if there's any other closing remarks.
Thank you, Megan.
Yeah, thank you so much, Megan. It's been a great time. And I believe everyone here has really enjoyed this session and have had a great time. Maybe let me allow Olatunji to actually close the session. But before I give it to Olatunji, I would like to mention that this, like we've said before, this series of workshops, and of course, the next one is going to be in October, which will focus on data collection using mobile technology. So it's actually going to be an impact measurement and management session for all impact-focused organizations. So it's going to be great. And of course, we'll have our friends from 60 Days will also, like a part of Acumen, also going to be leading the session. So we look forward to that session in October. Over to you, Olatunji.
All right, thank you so much, Joshua. Thank you, Megan, for all the work that you put into sharing for this session. I'm sorry, apology for my PAs that I have here making noise. And thanks to Joshua and Confidence also for the hard work. Thanks, Yvonne, we really appreciate your effort. Thanks for all the people that asked questions. Thanks, Evelyn, thanks so much for bringing the perspective, the unique perspective you brought in. Thanks, Leah, thanks, Isioma. Thank everyone. If I didn't mention your name, I appreciate you. We hope we will see you in our next session, which is going to be on using mobile technology to collect data, because it's also a continuity of the conversation of how we can be innovative and be adaptive in this time of COVID to still ensure that we support the ecosystem and keep the businesses going. So we hope we're going to see you at that session. And please stay safe. And we are here for you in Andy, West Africa. If you need any help, any support, please reach out to us. Even if you just need someone to talk to or rant. Yeah.
Careful what you wish for, Tunji.
So thank you so much, and please enjoy the rest of the day, depending on where you are in the world. Thank you so much, and
thanks everyone.
Thank you,
Bye.
Megan.
Bye.
Thanks, everyone. Bye.
Thank you.